The long synthetic future is a clever options strategy. It replicates the experience of owning a stock without buying the shares themselves. In its simplest form, it uses two trades executed at the same time: selling a put option and buying a call option. Both options must share the exact same underlying stock, the same strike price, and the same expiration date. When combined, the profit and loss profile behaves almost like holding the stock. That's why it's called synthetic stock or synthetic long. It's a way to create an artificial stock position using derivatives. One compelling aspect is cost efficiency. A synthetic long can often be opened with much less cash. In some cases, a trader may receive a small net credit when opening the position. The fundamental purpose of the long synthetic future strategy is to achieve a capital gain. This strategy profits from an anticipated increase in the underlying stock's price over a set period. It is not for generating income from dividends. It is not for profiting from a stock that trades sideways in a narrow range. Instead, it is a directional bet on an upward movement. If you believe a company's share price will rise significantly, this lets you participate like a stockholder. The profit comes from price appreciation of the synthetic position. For success, a bullish market outlook is absolutely essential. You must be confident the stock will move higher before options expire. If the stock falls, the position incurs a loss that mirrors owning the shares. So it's not for uncertain or bearish conditions. It's a tool for bullish traders only. Only deploy a synthetic long when your research and view are firmly positive and you accept the risk. The payoff profile is what makes it similar to owning stock. At expiration, the combined value equals the current stock price minus the strike. Above the strike, the call has value and the put expires. Below the strike, the call expires and the short put becomes a liability. One of the primary motivations for traders using the long synthetic future is capital efficiency. Buying 100 shares of an expensive stock like Tesla could require tens of thousands of dollars. For example, at a price of $200 per share, purchasing 100 shares would cost $20,000. The synthetic long strategy, however, often requires less initial capital. While your broker will hold money as margin to cover the short put risk, this is typically less than the full share cost. This leverage frees up funds for other investments. Another significant advantage is the potential to establish the position for a net credit. Especially when implied volatility is elevated, the premium from selling the at-the-money put can exceed the cost of buying the at-the-money call. This results in a net credit deposited into your account. That credit provides a small cushion and slightly improves the break-even point. Options add flexibility, defined timeframes, event targeting, and dynamic adjustments. You get pure price exposure without share custody or voting rights. Let's walk through a clear hypothetical example using Tesla, TSLA, to make these concepts concrete. We will use round numbers for simplicity. Imagine today is October 21st, 2025, and Tesla trades at exactly $200 per share. You're bullish over the next few months and expect the stock to rise. Instead of buying 100 shares for $20,000, you construct a long synthetic future. Goal: replicate the P&L of owning 100 shares. First, choose strike and expiration. At the money strike equals 200. Pick expiration about 3 months away, January 2026. Look up prices for the 200 strike. January 200 call equals $8 per share. January 200 put equals $10 per share. Note: one options contract equals 100 shares. Now execute the trade. Sell one January 200 put, receive $1,000. Buy one January 200 call, pay $800. Net credit equals $200. But your broker still requires margin because the short put carries risk. At expiration, case A, Tesla at 300, profit about $10,000 plus the 200 credit. Case B, Tesla at 200. Both expire worthless. You keep 200. Case C. Tesla at 100. About 9,800 loss after the credit. Entering a long synthetic future position requires careful and precise execution. Following a methodical, step-by-step process can help minimize errors and ensure you establish the position as intended. First, due diligence. You need a clear bullish thesis based on fundamentals, sentiment, and upcoming catalysts. Select an appropriate expiration that gives your thesis time to play out. Second, identify the at-the-money strike closest to the current price. If price is 249.50, choose the 250 strike. Use the exact same strike for the call you buy and the put you sell. Third, examine premiums. The put bid you'll sell and the call ask you'll buy. Calculate net credit or debit. Confirm margin requirements with your broker. Ensure you have sufficient funds to meet collateral for the short put. Place a combination order if possible. Submit both legs as one with a specified net price. This reduces leg-in risk. Adverse price movement between separate executions. Confirm symbol, expiration, strike, quantity, and net price before submitting. Then submit to the market. A defining characteristic is that both potential profit and potential loss are theoretically uncapped, just like owning the stock. On the reward side, there is no limit to how much you can profit. Above the strike, the long call's value typically rises about $1 per $1 move in the stock. Meanwhile, your short put remains worthless. Conversely, the downside risk is substantial until price reaches zero. This risk comes directly from the short put. If strike is 200 and price falls to 50, that's about $150 loss per share. If the stock goes to zero, loss approaches the full 200 per share, minus any initial credit. This demands immense respect and careful risk management. Proper position sizing is paramount. Risk only a small portion of capital. Stops can help but are not foolproof, especially with fast moves or overnight gaps. Unlike a long call with capped risk or a bull put spread with capped P&L, the synthetic long leaves both upside and downside open, a pure leveraged directional bet. Knowing how to exit a trade is just as important as knowing how to enter it. With a long synthetic future, you have several options for closing or managing the position. You do not need to wait for expiration. The most common method is to close both legs simultaneously. Buy to close your short put. Sell to close your long call. This flattens your position and locks in the result. If still bullish near expiration, roll. Close the current legs and open a new synthetic with a later date. You can keep the same strike or move to the new at the money. Depending on premiums, rolling can be a credit or a debit. Alternatively, let options go to exercise or assignment. Above the strike, exercise the call to buy 100 shares. Below the strike, assignment likely on the short put. Then you can hold, sell, or hedge the shares. Be aware of pin risk and exercise assignment logistics. Most active traders close before the final day, so plan your exit. While powerful, the synthetic long carries significant risks every trader must manage. Short put margin can increase sharply in a sell-off. Margin call risk. Early assignment risk rises if the put is deep in the money or near dividends. Use highly liquid options with tight bid-ask spreads. Volatility moves can help or hurt, even if price is flat. A volatility crush can reduce value. Factor in commissions, fees, and local tax treatment. Consult a professional. Size positions as if you owned the shares. The short put has uncapped downside. Start very small or paper trade first. In conclusion, sell an at-the-money put and buy an at-the-money call, same strike and expiration, to mirror stock movement. A capital gain strategy for bullish markets with uncapped risk and reward. Use disciplined sizing and clear plans. Good luck with your trades. Thank you for watching. See you next time.